Hey everyone, welcome back. Today we're diving deep into something that's super relevant, especially for those of you who are landlords or thinking about becoming one.
Absolutely. It's all about rental income and expenses in Canada for the 2023 tax year.
Perfect. To guide us through this, we'll be taking cues from the Canada Revenue Agency's guide, Rental Income T403623E.pdf.
Think of it as our roadmap.
Exactly. Whether you're a seasoned landlord or just starting out, this deep dive is designed to equip you with the knowledge to navigate this tax season.
Because let's be real, it's more than just collecting rent and paying bills.
Yeah.
There are nuances and strategies to consider, especially if you want to minimize your tax liability.
Okay, so let's jump right into it. One of the first things that popped out from the CRA guide was this whole concept of classifying rental income, right?
Yeah, you hit the nail on the head. It's about determining whether your rental income is classified as income from property or income from a business.
So could you break that down for us? What's the difference?
Sure. It boils down to the level of service you provide as a landlord. If you're simply providing basic services like heat and water, you typically fall under income from property.
Got it, the essentials.
But if you're going above and beyond by offering things like cleaning, meals, or even property management services, then the CRA might classify your rental operation as a business.
Ah, I see. So if I'm just sticking to the basics, does that make things simpler on the tax front?
Generally, yes. Classifying as income from property often means you'll be dealing with simpler tax forms and reporting processes.
That sounds good, but I'm guessing there are exceptions.
Of course, there are always exceptions. The CRA guide gives this interesting example.
Oh,
There's a tenant, Glenn, who helps out his landlord, Sonia, by plowing snow in exchange for a reduction in rent.
seems like a fair deal.
It does. But this seemingly simple arrangement actually bumps Sonia's rental operation into the business category.
Really? So even those little extras can make a difference in how our rental income is categorized.
Absolutely.
Yeah.
Every detail matters when it comes to taxes.
Okay, so I'm starting to understand why this distinction is so important, but can you elaborate a bit more? Why does it matter so much?
Well, this classification dictates the tax forms you use, how you report your income and expenses, and it can even affect the tax rate you'll pay.
Wow. Okay, so choosing the wrong classification could lead to some serious issues later on.
It's definitely a headache you want to avoid.
Noted. Now, speaking of forms, the guide mentions Form T776, the Statement of Real Estate Rentals. Is this the key document we need to focus on?
You got it. Think of Form T776 as your one-stop shop for reporting all things related to your rental income and expenses.
Okay.
It's neatly divided into sections for income, expenses, and something called capital cost allowance, or CCA.
CCA, we'll definitely have to unpack that later on.
We'll dive into that in detail. For now, just remember, Form T776 is your go-to form.
Okay, that's helpful. I also noticed the guide repeatedly emphasized accurate record keeping. It sounds like the CRA really wants to see those receipts.
Absolutely. They're serious about this. You're required to keep detailed records of all your income and expenses for at least 6 years.
6 years. Wow. Not everyone gets audited, right?
True, but you always want to be prepared, just in case.
Makes sense. So no more shoeboxes overflowing with crumpled receipts.
That's a good way to put it. Digital records are the way to go.
Yeah, digital seems way easier to manage, plus it's more environmentally friendly.
Exactly. Okay, so we know that the property owner is responsible for filling out those forms, but let's talk about how rental income is actually reported. What are the different ways someone can receive this income?
That's a good question. I'm assuming cash is the most common way, right?
Cash is definitely common, but it's not the only way. You can receive rental income through checks, e-transfers, and even in-kind, which means you're receiving goods or services instead of direct cash payments.
In kind. That's interesting. Can you give an example?
Sure. Remember Sonia and Glenn, our snowplowing duo?
Yeah, they had that unique arrangement.
Well, Sonia would actually have to report the value of Glenn's snowplowing services as in-kind income.
Wow, so even if you're not directly receiving cash, you still need to report it.
Precisely. The CRA wants to know about every form of income you receive.
Makes sense. Now, what about accounting methods? Is there a specific method we should be using for rental income?
Typically, you'll be using the accrual method of accounting. This means you report your income when you earn it, regardless of when the actual cash hits your bank account.
So even if a tenant pays their rent late, I still report it as income for the month it was due.
That's right. And the same goes for expenses. You deduct them when you incur them, not necessarily when you pay them.
So it's all about matching income and expenses to the correct period.
Exactly. The accrual method gives the CRA a more accurate picture of your rental operations profitability.
Got it. Now, what about situations where multiple people own a rental property together? How does the income reporting work in those cases?
In co-ownership situations, each owner reports their share of the rental income based on their percentage of ownership. It's pretty straightforward.
Okay, that seems fair. What if someone is simply guaranteeing a loan for the property but doesn't actually own it? Do they have any reporting obligations?
That's a good question. Even if someone guarantees a loan for the rental property, they don't get to deduct the interest expenses. Only the legal owner of the property can claim those deductions.
Okay, that clears things up. Now, I think we're ready to move on to the part every landlord loves deductible expenses. This is where we can potentially save some money, right?
You bet. Understanding deductible expenses is like unlocking a treasure chest of potential tax savings. But there are two main types of expenses to be aware of: current and capital expenses.
Okay, so what's the difference? Are current expenses those everyday costs we incur?
You're on the right track. Current expenses are those recurring costs that provide short-term benefits to your rental property. Think regular repairs, maintenance, those sorts of things.
So things like fixing a leaky faucet or giving the walls a fresh coat of paint would be considered current expenses.
Exactly. These are essentially the costs of keeping your rental property in tip-top shape.
And what about those bigger expenses, like replacing the roof or renovating a kitchen? Those feel more like investments to me.
That's a great observation. Those larger, more substantial expenses fall into the category of capital expenses.
So I'm guessing the way we deduct those two types of expenses is different, right?
You're absolutely right. Current expenses are usually fully deductible in the year you incur them.
Okay, that makes sense. What about capital expenses? Do we deduct the full amount all at once?
Not quite. Capital expenses are depreciated over several years through what's called capital cost allowance, or CCA.
Ah, see, that term keeps popping up. We'll definitely need to break that down later on.
We'll get to that. Just know that it's a way to spread out the deduction for those bigger expenses over time.
Okay, I'm starting to see how all these distinctions can have a big impact on my overall tax strategy. But before we move on, I'm also curious about those soft costs mentioned in the CRA guide. What are they exactly?
Soft costs. Those are interesting. These are the expenses that crop up during construction or renovation, but aren't directly related to the materials or labor.
Oh, I see. Can you give us some examples?
Sure. Things like legal fees, architectural plans, permits, and even the interest you pay on those construction loans, those all count as soft costs.
Interesting. So are these soft costs treated as current or capital expenses?
It depends. Sometimes they can be fully deducted right away as a current expense. Other times, they need to be added to the cost of the building and then depreciated over time.
So there's no one-size-fits-all approach.
Precisely. It really depends on the specific situation.
Okay, so we've covered the broad categories of expenses, but I'm super eager to dive into the nitty-gritty of those specific deductible expenses. The guide lists a whole bunch of them.
There's a lot to unpack, that's for sure. But I think focusing on the ones that often trip landlords up or offer some surprising opportunities to save would be super helpful.
Sounds good to me. Welcome back. I'm excited to dive into some of these specific deductible expenses. Where do you think we should start?
Well, advertising costs seem like a logical place to begin. After all, you need to get those tenants right.
Absolutely. Attracting good tenants is crucial. So what can we actually deduct when it comes to advertising our rental property?
The good news is you can deduct pretty much any reasonable expense you incur to advertise your property.
Okay.
We're talking online listings, newspaper ads, even those flyers you might post around the neighborhood.
So if I decide to pay extra to boost my online listing, that's deductible too.
Exactly. As long as it's directly related to finding tenants, the CRA is usually on board.
That's helpful to know. What about insurance? I know we need to protect our investments, but are there any special rules for deducting insurance premiums?
There's one key thing to remember with insurance. You can only deduct the portion of the premium that covers the current year.
So I can't just deduct the entire lump sum if I pay for a multi-year policy up front.
That's right. Let's say you pay for a 3-year policy all at once.
Okay.
You can only deduct 1/3 of that total premium each year for the duration of the policy.
Got it. So it needs to be spread out. Makes sense. Now let's talk about a big one, interest and bank charges. These can really add up, especially when you factor in a mortgage.
Definitely a major expense for most landlords. The good news is you can generally deduct interest charges on money borrowed to buy or improve your rental property.
So that includes mortgage interest.
Absolutely. It also includes interest on any loans you take out for renovations or repairs to the property.
Okay, that's pretty straightforward. But what about the principal portion of my mortgage payments? Can I deduct that too?
That's a common misconception. You can only deduct the interest portion, not the principal repayments.
So I need to be diligent about separating those two amounts on my mortgage statements.
Exactly. Don't just lump the whole payment together. The CRA is very specific about what's deductible.
Got it. Now, what about all those fees and charges that come with getting a mortgage? Are any of those deductible?
Good question. Some of those fees associated with securing a mortgage for your rental property are deductible.
Okay.
Things like appraisal fees, legal fees, and even those sometimes hefty mortgage insurance premiums.
So there are some upfront costs we can potentially deduct, not just the ongoing interest.
That's right. But here's a little wrinkle. These fees need to be amortized over a period of 5 years, regardless of the actual term of your mortgage.
Amortized, meaning I can't deduct the entire amount upfront.
Exactly. It's a bit like spreading out the cost of a capital asset over its useful life.
So I divide the total fees by 5 and deduct that amount each year for 5 years.
Precisely. This way, the deduction is matched to the period the property is actually being used to generate that rental income.
There seem to be a lot of these little nuances we need to be aware of.
There are. And here's another one that often catches landlords off guard. Let's say you decide to make a large prepayment on your mortgage to try to snag a lower interest rate.
Okay, that sounds like a smart move.
You can be, but you can't deduct that entire lump sum interest payment in the year you make it. You'll have to spread it out over the remaining term of your mortgage.
Spreading it out again. I'm sensing a theme here.
It's all about matching those expenses to the relevant income periods. The CRA is all about consistency.
Makes sense. Okay, let's move on to repairs and maintenance. This is another big category for landlords. What are some key things we need to remember when deducting these costs?
The main rule here is that you can deduct the cost of labor and materials for repairs that are necessary to keep your property in good rentable condition.
Okay.
But there's a catch.
Uh-oh, I was afraid of that.
If you decide to roll up your sleeves and do the repairs yourself, you can't deduct the value of your own labor.
Wait, seriously. So if I fix a leaky faucet myself, I can't deduct the cost of my time?
Unfortunately not. The CRA only considers your actual out-of-pocket expenses, not the value of your, shall we say, sweat equity.
So to deduct the repair cost, I'd have to hire a plumber.
Well, not necessarily. You can still DIY those repairs, but you'll just have to forego the deduction for your labor. You can still deduct the cost of the materials, though.
I see. So it's a trade-off. Do I save money up front by doing it myself, or do I maximize my deductions by hiring a pro?
Exactly. It's a balancing act that many landlords face. Weigh the value of your time against those potential tax savings.
That's a good point. Are there any other tricky situations that come up with repairs and maintenance?
The line between repairs and improvements can sometimes get a little blurry.
I can see how that might be confusing. What's the difference?
Repairs are generally those actions you take to sell something that's broken or worn out.
Okay.
They're about restoring things to their original condition. Improvements, on the other hand, go beyond simple repairs. They're about enhancing the property or extending its useful life.
Can you give us an example of where that distinction might be a bit fuzzy?
Sure. Let's say you have an older rental property with some outdated kitchen cabinets.
Okay.
If you simply repaint those cabinets to freshen them up, that's probably considered a repair, fully deductible.
Got it. What if I want to do more than just a fresh coat of paint?
Well, if you decide to rip out the old cabinets and install brand new ones, along with new countertops and appliances, that's likely going to be considered a significant improvement.
So it's about the scale and the intention of the work being done.
That's a good way to put it. The CRA looks at those factors to determine whether it's a repair or an improvement.
Okay, that makes sense. What about those situations where I have employees helping me manage the property? Can I deduct their salaries and benefits as expenses?
Absolutely. If you have employees like a property manager, a superintendent, or even cleaning staff, you can deduct their salaries, wages, and any benefits you provide.
So things like Canada pension plan contributions, employment insurance premiums, even health insurance benefits, those are all deductible.
That's right. You're essentially running a small business within your rental operation.
And speaking of running a business, what about travel expenses related to my rental property? Can I deduct those? Let's say I need to drive to the property to meet with a contractor or to inspect a repair.
Travel expenses can be a bit tricky. The CRA has specific conditions for deducting travel costs related to your rental property.
Ooh, like what?
Generally, you could deduct those travel costs if your rental property is your only one and it's located in the same general area where you live.
So if my only rental property is in the same city where I live, I can deduct the cost of driving there to meet a plumber.
In most cases, yes. But if you own multiple properties or your rental property is located far away, the rules can get a bit more complex.
Okay, distance and the number of properties come into play. What about using my personal vehicle for tasks related to my rental property? Can I deduct those costs too?
The CRA does allow you to deduct motor vehicle expenses, but again, only under certain conditions.
Okay, so it's not a free-for-all. What are some of those conditions?
Well, if you only own one rental property and you're handling things like repairs and maintenance yourself, you might be able to deduct those vehicle expenses for trips to pick up supplies or meet with contractors.
So I can't just deduct all my mileage because it's somehow related to the rental property.
That's right. The CRA keeps a close eye on these sorts of deductions. You need to keep really detailed records of your mileage and the purpose of each trip.
I bet they do. Now, what happens in those unfortunate situations where a tenant doesn't pay their rent? Is there anything we can do from a tax perspective to soften that blow?
There is. You might be able to deduct that uncollectible rent as a bad debt, but there are a few hoops to jump through.
I bet there are. What are those conditions?
First and foremost, you need to be able to show that you made a real effort to collect that rent.
So sending a strongly worded email isn't enough.
Not quite. Think repeated notices, maybe even legal action, the whole 9 yards.
So I need to demonstrate that the debt is truly uncollectible.
Exactly. And you'll need documentation to back up your claim. Things like copies of notices, any correspondence with the tenant, or even court documents.
It sounds like good record keeping is essential for pretty much every aspect of rental income and expenses.
You got it. Now, just as important as knowing what you can deduct is knowing what you can't deduct. Want to explore some of those non-deductible expenses.
Absolutely. Let's shed some light on what we can't deduct before we move on to the complexities of CCA. Welcome back. I'm ready to tackle those non-deductible expenses. What are some of the common ones that landlords might mistakenly try to deduct?
One big one is the principal portion of your mortgage payments. Remember we talked about how you can only deduct the interest portion, not the actual repayment of the loan itself.
Right, that was a bit of an aha moment for me. What else should we be aware of?
Land transfer taxes are another common culprit.
Yeah.
Those taxes you pay when you purchase the property.
Okay.
Those get added to the cost base of the property. They're not a deductible expense.
So they'll come into play when I eventually sell the property, right?
Exactly. They'll factor into the capital gains calculation down the road.
Got it. Are there any other non-deductible expenses we should keep in mind?
Penalties are a big no-no. Any penalties you incur from the CRA, those are not deductible.
So if I file my taxes late or accidentally underreport my rental income, I can't deduct those penalties.
Nope, those are on you.
That makes sense. You can't really deduct costs that result from not following the rules.
Exactly. And remember how we talked about not being able to deduct the value of your own labor for repairs and maintenance?
Yeah.
Well, that same principle applies more broadly. You can't deduct the cost of your time spent managing the property, finding tenants, or doing all those administrative tasks.
So even though those activities are essential to running a successful rental operation, the CRA doesn't consider them deductible expenses.
That's right. It's a good idea to keep that in mind when you're assessing the overall profitability of your rental property factor and the value of your time.
Okay, noted. I think we've covered a lot of ground on the expense front. Now I'm ready to tackle that mysterious concept of capital cost allowance, or CCA. It sounds a bit intimidating, to be honest.
It might seem a bit daunting at first, but it's essentially a system that allows you to deduct the cost of wear and tear on your rental property over time. Think of it as depreciation for those big-ticket items.
So instead of deducting the entire cost of the building or a major renovation all at once, we spread those deductions out over several years through CCA.
That's the gist of it. The CRA has established various classes of depreciable property, each with its own specific CCA rate.
So the type of asset determines how quickly we can depreciate it.
You got it. For example, most buildings fall under Class 1 with a CCA rate of 4%,
Okay.
while things like furniture and appliances are typically in Class 8 with a CCA rate of 20%.
So we can depreciate furniture and appliances much faster than the building itself.
Exactly. The CRA has a comprehensive list of asset classes and their corresponding CCA rates in their guide.
Got it. So how do we actually calculate the CCA we can claim each year?
You take the appropriate CCA rate and apply it to the remaining balance of the asset's value. It's called the declining balance method.
So the CCA deduction gets smaller and smaller each year as the asset depreciates.
That's right. Now, when you first acquire a depreciable property, there's a special rule called the half-year rule.
I saw that mentioned in the guide. What does that mean exactly?
It means you can only claim half the CCA in that first year you own the property.
So if I buy a new refrigerator for my rental property in June, I can only claim half of the CCA for that year.
Precisely. It's like the CRA recognizes you didn't have the asset for the full year.
Okay, that makes sense. Now, what happens when I eventually sell my rental property? Does CCA affect my taxes when I sell?
It definitely can. When you sell your property, there's a chance you might experience something called recapture or terminal loss.
Those terms sound a bit technical. Can you break them down for us?
Sure. Recapture happens when you sell the property for more than its remaining undepreciated value. You essentially have to add back some of the CCA you claimed over the years to your income in the year of the sale.
So it's like the CRA is saying, hey, you benefited from those deductions, so we need to adjust your income now that you're selling.
You could say that. On the other hand, a terminal loss occurs if you sell the property for less than its remaining undepreciated value.
And what happens in that scenario?
You can actually deduct that remaining undepreciated amount, which can lower your tax bill.
So there's potential for either a gain or a loss when selling, depending on how much the asset has depreciated over time.
Exactly. That's why understanding CCA and its impact on your taxes is so important. It can help you make smart decisions about when to sell your property.
It definitely adds another layer of complexity, but mastering CCA can lead to some significant tax savings in the long run.
For sure. Now let's shift gears a bit and talk about another important concept.
Yeah.
Principal residence, designation, and change in use. Here in Canada, we have a great benefit called the principal residence exemption.
I've heard about that. It basically exempts you from paying capital gains tax when you sell your primary home.
You got it.
Huh.
But things can get a bit tricky when you decide to change how you use that property. Let's say you convert your principal residence into a rental property, even partially.
Okay.
The CRA might view that as a deemed disposition.
Deemed disposition. That sounds a bit ominous.
It's not as scary as it sounds. It basically means the CRA treats it as if you sold the property and then immediately bought it back, even though no actual sale took place.
Why would they do that if I haven't actually sold the property?
Remember, capital gains on your principal residence are tax exempt. But once you change it to a rental property, those gains are no longer sheltered. The deemed disposition triggers a calculation of any capital gains up to that point.
So converting my home into a rental could result in a taxable event even if I haven't sold it.
It could, but there are ways to defer or even completely avoid those capital gains. The CRA guide outlines some elections you can make. Yeah, things like the Section 45(2) and Section 45(3) elections. Don't worry too much about the technicalities. These elections can help you manage the tax implications of changing how you use your property.
So it's crucial to understand these rules and explore all the available options to minimize any potential tax hit.
Exactly. Plan ahead and be strategic.
Okay, one last question on this topic. What about those flipped property rules I saw in the guide? Those seem new.
Those are new rules introduced for 2023. Essentially, if you own a property for less than 365 days before selling it, the CRA might consider it a flipped property.
And how does that affect me from a tax perspective?
Well, if it's considered a flipped property, any profit you make from that sale is fully taxable as business income, not as a capital gain.
So it's taxed at a much higher rate.
Exactly. The CRA is cracking down on those quick flips.
They want to discourage people from buying and selling properties just for short-term profit.
You got it. They want to make sure profits from real estate are being taxed appropriately.
Well, we've covered a ton of ground today. We've explored the ins and outs of rental income and expenses, tackled the intricacies of CCA, and even navigated those tricky change-in-use rules and flipped property scenarios.
It's been quite a journey. But hopefully, you're feeling more confident about managing your rental income and minimizing your tax liability.
I know I am. Before we wrap up, are there any key resources or parting words of wisdom you'd like to leave our listeners with?
The CRA website is an absolute goldmine of information. You'll find the guide we've been using, Rental Income T403623E.pdf, along with tons of other helpful resources.
So even if you're listening to this deep dive in the future, you can still head over to the CRA website and find all the latest guidance.
Absolutely. And if you have more complex questions or just need some personalized advice, don't hesitate to reach out to a tax professional.
They can help you create a solid tax strategy that's tailored to your specific situation.
Exactly. Well, I think we've reached the end of our deep dive into the world of Canadian rental income.
It's been a pleasure exploring all these nuances with you. We hope our listeners are feeling empowered to take on this tax season with confidence.
Happy renting, everyone!
And remember, knowledge is power. The more you know, the better equipped you'll be to make smart financial decisions. Thanks for joining us.